Students, welcome to the massive open online course on money and financial markets. I hope you remember that in previous module we have discussed the instruments of monetary policy 1. In that lecture, I tried to cover a few things in general. I tried to give you a brief overview of the monetary policies generally adopted by the Reserve Bank of India. Now, in today's module, we will move to instruments of monetary policy 2. In the backdrop of instrument of monetary policy 2, we must remember what we have discussed in our previous module. In this module, we will try to be very specific. Specific in the sense that in this module, our primary objective would be to make you understand how various monetary policies are used in respect of different specific problems during times after independence. So we can easily give you a broad outline or an sort of exhaustive monetary policies from the perspective of RBI in order to ensure economic development, in order to ensure economic stability, in order to ensure price rigidity, in order to ensure stable employment scenario. But I decided not to go for it. I decided to break all these policies into different time frames. One is pre-liberalization phase, because in Indian economic history, the most remarkable thing that took place in the 90s of last century. So I tried to draw a structural break sort of line during that time. So during 90s, more specifically 1991. So before 1991, we have pre-liberalization phase. Under pre-liberalization phase, I will also have two development phases. One development phase 1, the other is development phase 2. And then comes liberalization, new economic policy in Indian economic history that took place in 1991. And from that time, liberalization, we will briefly discuss a few points that covers few years, only few years. That is termed as liberalization and early reform phase, the early phase after economic reform. And who was very instrumental for this economic reform? Dr. Manmohan Singh was very instrumental for the economic reform that India experienced in 1991. And then we have post-liberalization phase in the sense that the initial shock or initial changes that was subdued or settled and then started giving the dividends. So what happened during post-liberalization phase? And what were the policies that have been devised by the Reserve Bank of India? And then what came to the scenario? The global financial crisis. Worldwide, we experienced global financial crisis during the first decade of this century, 2008 and 9. The crisis started in America, then it went on to sort of disturb the economy throughout the globe. And then what happened during and after global financial crisis? We use the term GFC to denote global financial crisis. And as we all know, then what we have? COVID-19, 2019. And what is the role that RBI did play during COVID-19? Because almost all the countries in this globe experienced severe economic setback. But fortunately or unfortunately, India did not. So it is quite apparent and it is understandable that the central bank, Reserve Bank of India, definitely it has played a very significant and constructive role to safeguard the Indian economy from global shock, global economic shock that was originated due to the global health shock, namely coronavirus or COVID-19. So our next target was to explain a few things associated with COVID-19 pandemic and India's monetary policy. Students, I hope that you will enjoy this classification, demarcation, and try to relate few things that I explained in the previous lecture. So, as I mentioned in my previous lecture that on instruments of monetary policy 1, that the focus was on how the Reserve Bank of India, in fact in this lecture, used its various instruments in response to needs from pre-liberalization era to the recent past. So that we are planning to cover as a whole. And as I said, if you remember, that the prime motive of the Reserve Bank of India was to maintain a stable price. So that was the top priority of the Reserve Bank of India. So be it for economic or for political reasons. Also here I want to mention that not to forget one important thing, which is called crony capitalism. I'm not saying crony capitalism is good. I'm not saying crony capitalism bad. I'm not saying it is not desired. But as a person, I think that you should be aware of what is crony capitalism. Crony capitalism essentially talks about the influence of rich investors, influence of the biggest businessmen of a country in the economic policy making. And you know that there are two different branches of economic policies. One is called monetary policy, that is governed by Reserve Bank of India. The other is called fiscal policy, that is governed by the Government of India. So crony capitalism says that when the rich investors or the businessmen can influence the economic system through their channels, through their association with political leaders, through their association with the government, in order to influence the policies so that they can get huge benefit, keeping a blind eye to the distributional issue of the economy, keeping a blind eye to those who are have-nots in the economy. And in economy, in case of Indian economy, this is a burning problem. We cannot ignore the issue of poverty. We cannot ignore the issue of malnutrition. We cannot ignore the issue of health crisis. We cannot ignore the issue of educational problems. But crony capitalism is not interested about overall upliftment. So here the issue of crony capitalism should also be taken into account by the Reserve Bank of India. And that is a biggest challenge, not only in India, but in all other countries as well. So with this, what we can say is that infusing liquidity in times of need to maintain economic growth, stabilizing interest rate. The case of interest rate I explained in great detail at the fag end of our previous lecture. So stabilizing interest rate, etc. were other objectives. Now, one by one, we will move to that. In the pre-liberalization phase has two components, two divisions as I said. One is development phase 1, 1951 to 1970. There is no hard and fast rule. You can have 1951 to 1975. For my own convenience, I have demarcated this as 1951 to 1970, just roughly it is 20 years. So early monetary policy was geared here to support planned expenditure and the government deficits. Several qualitative and quantitative control measures were introduced to contain the consequence of inflationary pressure, because I'm saying time and again repeatedly that containing inflationary pressure and having a stable, rigid price level is the prime motive of the monetary policy, is the prime motive of the Reserve Bank of India. Because, if you just cannot handle or balance the shock and the consequent policies to recover from the shock, it may go anywhere. Just for an example, during agricultural shock, a monetary policy would initially be to support the drought relief. But if you continue to produce or continue to go on with the subsidized scheme, then, when agricultural shock is there, agricultural production goes down. If agricultural production goes down, naturally industrial production will also decline. Now, if the government goes on with subsidized policies, government goes on with increased money supply, government goes on with providing money to the general people, then on the one hand, what is happening? Money in the hands of general people like you and me is going up. On the other hand, the shock originated from agricultural sector being translated to the industrial sector, and the production goes down, employment goes down. But as a person, I'm getting money from the government. So what is going to happen? There is no supply of the goods and services produced in the economy. But I have money. So I have huge money, I will try to buy. But I do not have enough goods. So more money is changing less or few goods. If that happens, inflation or increase in price level is inevitable, and government cannot afford it. The government has to ensure that Reserve Bank of India is developing such a mechanism that this problem can be controlled. And again, measures included selective credit control, credit authorization schemes that I mentioned in our previous analysis or lecture, and social control measures to enhance the flow of credit to priority sectors. This must be kept in mind that the priority sectors is earmarked by the government. So other measures included selective credit control, credit authorization scheme, social control measures to enhance the flow of credit to the priority sectors. These priority sectors are earmarked by the government. Just like government can earmark infrastructure, government can earmark health, government can earmark aviation industry as the priority sectors. Government can earmark agriculture and the rural development as the priority sectors. So accordingly, Reserve Bank of India should ensure that the proper amount of loan and financial support is provided for these priority sectors. And then after that, we move to development phase 2, that is 71 to 90. And during 1971 to 90, this is the phase that is coinciding with the phase after bank nationalization. Bank nationalization took place in 1969. The focus of the monetary policy not was particularly on the price rigidity or controlling inflation, but the move to the policy on credit planning. The dominance of fiscal policy over monetary policy accentuated and continued through 1980s. And here, the statutory liquidity ratio that I mentioned was raised from 25% in 1970 to 38.5% in 1990. And then also they tried to neutralize the inflationary impact of deficit financing. Deficit financing I'm not going to explain here. I'm pretty sure that you know this thing from macroeconomics. So in order to neutralize the impact of deficit financing, cash reserve ratio or CRI were also gradually raised from 3% to 15% of NDTL, means demand and time deposit of. So bank rate had nothing much to do during that time. And then comes 1991 to 1997. In 1991, we had economic policy or economic reform. That led to a paradigm shift in the financing of the government and the commercial sectors. Interest rates were completely market determined during that time, and that was a problem of Indian economy. Indian economy was not linked with the market, and the economic reform of 1991 that ensured that the economic functioning or the changes in economy should be directed, not exactly governed, but should be directed by what the market is saying. And the exchange rate was liberalized. Now rupee became fully convertible. So that was a very important change in that phase. And after that, that was just the initiation of economic reform. And the dividend and the result came just after 5 or 6 years. So I have post-liberalization phase from 1998. Then RBI introduced interim liquidity adjustment facility. These are different committees, Narasimham Committee 1 and Narasimham Committee 2. Narasimham was a governor of Reserve Bank of India. So he headed two committees and developed certain mechanisms to ensure the issue in tandem with other policies of the government, rather, I should say, in line with the government priorities. And then uh, liquidity adjustment facilities gradually transited into full-fledged liquidity adjustment, and the LAF was operated through overnight fixed rate repo. These are certain ornamental policies, but it is not going to have, they didn't have much more effect on these issues. But we had an interesting dimension there. What I said is that after 15 or 16 years after economic reform in India, the whole world was hit by global financial crisis. What was the global financial crisis? Global financial crisis is the housing crisis that started in America in 2007 and 8. And probably you have heard the name Lehman Brothers. Lehman Brothers is the name of a bank. So the main idea was, at that time in America, huge amount of loan was disbursed in the housing sector without looking at the stringent policies whether the borrowers are in a position to give some money or pay back the loan. So that global financial crisis hit the entire world. So that translated into supply side inflation, and that posed challenges for the conduct of the Reserve Bank monetary policy. And there is a sign of cyclical economic slowdown on the one hand, and the risk of spiraling headline inflation on the other hand. But the Indian economy during that time witnessed moderation in growth. Now here I want to mention one thing, that Indian economy during pre-reform phase, they didn't have much interesting growth rate. And the growth rate that we experienced during that time is popularly known as Hindu growth rate. Hindu growth rate is nothing to be related with something Hindu, but it is essentially, some people try to explain this very nominal, minimal growth rate with the Hindu idea of fatalism. So whatever happens, that is written on my fate. So that was the idea of Hindu growth rate. So we were not in a position to accept what the market is dictating us. So then economic reform helped us to come out of this thing. And Indian economy was also experiencing a situation of import substituting industrialization. Import substituting industrialization means you need not to import, rather instead of importing the good, you produce it here so that you can generate employment. Forget about whether you are efficient in producing or not. That is completely in contrast with what economic arguments say. Because economic arguments say that if I am efficient, I will do this. But this import substituting industrialization, forget about economic efficiency. If you want to increase employment, even if you are inefficient, you do this thing, because otherwise you would not be able to earn money. Now in this way, you may lose in the long run, but that was not the concern of the government during that time. But economic reform tried to solve this problem. As I was saying, during global financial crisis, Indian economy witnessed a moderation in economic growth in the second half of 2008 and 9. But interestingly, before that, Indian economy was experiencing a good rate of growth. So sort of 8.8% per annum, but it went down only because of the fact that the world economy was suffering from the shock of global financial crisis. The domestic aggregate demand also moderated, and this happens, which is quite natural during any economic crisis. People becomes very skeptic about the consumption pattern, so demand goes down, so the growth suffers. So that also happened in India, but not in a very aggressive fashion that had been experienced in other countries like developed countries, America, Europe, and other countries. In order to respond to this slowing demand, fiscal stimulus measures were undertaken by the government, which included both tax cuts and the increase in government expenditure. And then during the initial phase of the global financial crisis, Indian financial market almost remained almost unaffected, as the direct exposure of banks to the global subprime assets means the housing assets, was negligible, and the growth process were driven primarily by the domestic demand. And almost India and the other emerging market economies were decoupled from the advanced economies. So, kind of insulation. So, Indian economy was sort of insulated from this shock and the after effects. And then the crisis intensified. The Lehman collapsed, but the American bank came up. And probably you have heard that there is one economist who got the Nobel Prize whose name is Bernanke. Bernanke was very instrumental in bailing out this American economy or Lehman Brothers during the financial crisis, and how to handle the banking system during financial crisis. That had been explained very nicely and implemented by Bernanke, and as a result of that, Bernanke got Economics Nobel Prize. And then, due to India's rapid international trade growth in information technology, a significant boost came to the global integration. This is very interesting. Indian economy, the growth of Indian economy is primarily now driven by English knowing, technology savvy, computer savvy, smart Indian youth. And these group of people are working in IT sectors. So this growth saga of Indian economy is primarily a growth saga of information communication technology. So this is the driving force of Indian economy, and we should focus more on this. I'm pretty sure that the Reserve Bank of India and the government is aware of these things. And then, now what I can say that the Indian economy cannot remain immune to global crisis and global trends. So during that time of global financial crisis, essentially, what I want to say is that I should say that the Reserve Bank of India should be appreciated, should be thanked for handling the entire crisis very intelligently, so that the economy was not much disturbed for a reason. But worldwide, we experienced that. The economists came up with two problems. One is called impossible trinity. Impossible trinity, I'm not going to explain much, because this is a little critical issue, but I want to mention few things. There are three things an economy want to have: stability in various fronts, price, employment, and income. But in order to have this stability, there are three picks that one should look at. One is free capital flow, inflow and outflow. So that capital can come to India, capital can move out of India, depending on domestic rate of interest and international rate of interest. And sovereign monetary policy, whether the Reserve Bank of India can go for monetary policy in its own. So that is sovereignty of the central bank of any country, and the fixed exchange rates. So what it says that if a country opts for fixed exchange rate, free flow of capital, then it surrenders its ability to have an independent monetary policy. If a country opts for a free flow of capital and an independent monetary policy, then it is compelled to allow the exchange rate to fluctuate. So the bottom line is that out of these three, you can only have two, not the three. The moment you have only two, definitely there would be some problem in the economic front, or the social front, or the socio-economic front, or in the distribution front. How to solve this problem? That is a bigger domain, bigger discussion. So, but I want to mention that this is a problem that one must be aware of. And then comes this impossible trilemma and new trilemma. But this is somewhere related with the impossible trinity that I just discussed. But now comes a very interesting one. This is developed by one Harvard professor, Turkish professor, Danny Rodrik, famous trade theorist. He said that it is not only the open economic trilemma, but there is another trilemma which is called globalization trilemma. One interesting person whose name is Yuval Noah Harari very recently said that globalization is a process. Now we can stop it. You can just slow down. So you may go for globalization. This term was coined by Paul Antras, another Harvard professor. So globalization is taking the form of globalization in a slow pace. So Danny Rodrik said that it has also some impossible issues. Hyper-globalization cannot go with democratic policies. If you go for globalizing your economy in a rapid way, you must compromise with your democratic setup. The voice of democracy should not be, seen somewhere very candidly. So this is one issue. And if you go for very aggressive or hyper-globalization, that may jeopardize your nationalistic sentiments, that may jeopardize your nationalistic sovereignty, that may hamper your national priorities. So how to solve? That is again to be discussed at a higher level by best brains of the world, best economists of the world. So these are the certain issues, and then I am almost at the end of this lecture of Instrument of Monetary Policy 2, but I cannot stop without saying something about the COVID-19 pandemic, because COVID-19 pandemic imparted global crisis, imparted economic shock, just like any other countries. India was no exception. But again, I should thank Reserve Bank of India for maintaining price stability. For maintaining price stability means, during this pandemic, RBI has expanded its policy interventions beyond inflation containment to liquidity management and also to regulatory roles. To increase liquidity, the RBI responded to the COVID-19 pandemic by reducing the repo rate under the liquidity adjustment facility by 40 basis points. So whenever you listen that it is 40 basis points, it means 0.4%. If it is 100 basis points, it is 1%. If it is 400 basis points, it is 4%. So don't confuse with 400 and 400 with 1. So the basic idea is that. But yes, what I want to say is that RBI handled the whole thing very efficiently, and the CRR 2 was cut by 100 basis points in May 2020 during the pandemic. RBI also infused liquidity to the system to the tune of 5.66 lakh crores in May 2020 during, peak phase of the pandemic. Up to May 20, it was 4.75 lakh crores in April 2020. So RBI's stance was as a whole a sort of accommodative then, and with the objective of achieving what? Again, going back to the original thing, going back to the main target, with the objective of achieving a stable inflation rate of 4%, with a caveat of plus minus 2%. So what are the takeaways of this lecture today? Very briefly, we have seen that RBI's monetary policy over the years. And what we got to know from that? Events like liberalization and global financial crisis, even keeping in mind the new COVID pandemic, changed the course of action of the central bank, Reserve Bank of India. So Reserve Bank of India actually molded its nature and character and functioning with the tune of the time, with the need of the hour, which is very, I should say, approach that we should be proud of. Because RBI is our parent organization, central bank, the parent bank of all the banks. The modes of operation of RBI changed over the years. Target remained almost the same always. What was the target? Price stability, inflation. Along with these other targets, which varied time to time, are promoting growth, as I mentioned again before, stabilizing interest rate and exchange rate were also the main focal points. Sometimes these objectives are consistent with others and sometimes they are not. But it happens. You cannot fulfill all the targets always. But the thing is that we need to keep on working. We need to target. We need to fix our desired goals, and we need to work to achieve those goals. And RBI has been doing this thing from its inception. So I hope that you enjoyed the whole thing and what are the instruments of various policies. I tried to look at all these things very clearly. And thank you very much. And I'm sure that you will have a clear idea to understand what the economic times page or economics page of a newspaper says to us regarding the economy of India. Thank you very much. Thank you once again.